Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Sunday. Hope you had a great week. Thanks for joining us. I'm going to be joined today by members of the media, academia, and financial services as we analyze all the information this week in retirement markets, technology, personal finance, so much more. So sit back, relax, and enjoy this episode of BRN Sunday. Let's kick things off with a look at personal finance, And joining us on the line, she's a personal finance reporter with The Motley Fool. Let's welcome to the program, or back to the program, Mari Backman. Mari, Happy New Year to you and your family.
Thanks, Jeff. Same to you.
Well, thank you. New Year, coronavirus is still here, but I know you wanted to talk today a little bit about the facts around checks that have been, I think, issued as part of this relief package that was passed late, very late in 2020.
Yes, very late, 11th hour, but after months of negotiations, lawmakers actually did come to an agreement on a relief bill that was passed into law. So this is the follow-up relief to the CARES Act, which was signed into law in late March. That was the first bill that provided a fair amount of relief during the pandemic. Now we've got this new $900 billion deal. It's got a bunch of stuff happening in it. It's got boosted unemployment. It's got some rental assistance, a second round of paycheck protection program loans for small businesses. So there's some good stuff in there. But I think what people are most concerned about is the second stimulus payment that's going out. So the relief bill allowed for a $600 stimulus payment. Now, Jeff, if you remember from the CARES Act sent out $1,200 payments. So this time around, people are only getting half the money they got from the first round. So I think for one thing, I think we could talk for a second about the fact that, that's a bit of a bummer, and that's putting it lightly because, given the number of people who are struggling with unemployment, income loss, or other just unexpected expenses that have arisen in the course of this pandemic, $600 unfortunately is not going to go very far. Now, to be fair, that $600 is per person, and that includes eligible dependents. So, if you've got a family of 5 people, you might conceivably be getting $3,000 if you've got, if your income qualifies you, and let's say you're a set of parents and you've got 3 children, under the age of 17. That could be a $3,000 check, and obviously that does a little better. It seems more meaningful when you think about it that way, but at the same time, you still have to remember that a family of 5 getting $3,000, well, sure, they're all sharing rent or a mortgage, but that's still extra mouths to feed. So when you compare, that to a $600 payment for one person, I mean, it's hard to say who's coming out better. But obviously the $600 wasn't what people wanted. People wanted more. But given that at different points during negotiations, lawmakers were talking about putting no direct stimulus payment at all into the bill, I think, unfortunately, we have to just look at the 600 and say, all right, well, we'll take what we can get.
Yeah, Mari, I mean, $600, if it was $1,200, it still doesn't go very far if you don't have a job. You're one of the 10 million people that are unemployed in this country, still unemployed. It doesn't go very far, and obviously doesn't solve the problem of not having a job, right?
Right. Yeah. And I mean, and to be fair, it's not meant to, and I think there's this misconception about these stimulus payments that they're supposed to really, dig people out of these deep financial holes. I mean, they're not going to do that. Even a $1,200 payment is not going to do that. Even the $2,000 payments that lawmakers were then pushing for after they determined that 600 was the figure they were going to go with, even a $2,000 payment, it's not going to do a whole heck of a lot for someone who was earning, let's say $70,000 a year and is now, collecting maybe half of that, if that, between unemployment and boosted unemployment. It's not going to make up for somebody losing half of his or her income. What it will do is for people who maybe, have taken a small hit, it'll help, right? It'll maybe help that family that hasn't necessarily lost a job or lost income, but now because of this remote schooling situation, maybe they're paying extra for childcare. Maybe that's a burden, Maybe they need to whip out their credit card at the end of the month because all of a sudden their monthly expenses are a bit higher, so that helps. So, I mean, it's helpful. It's not a complete lifeline, but it is helpful. And the other thing that it's supposed to do, I mean, it's called a stimulus payment for a reason. It's supposed to actually stimulate the economy. So part of the hope is that people are going to take that money and spend it at businesses and stores that need the revenue too. But before we, run out of time here, I just want to let people know what to expect with this payment because it's a little tricky this time around. So first of all, the good news is if you got your first stimulus payment via direct deposit, then you should expect your second stimulus payment to arrive the same way. And in fact, there's a good chance you probably have that payment already. So for people who don't go in and check their bank account balances every day, and I mean, not all of us do, why would we? Kind of like an exercise in futility for some of us. But if you haven't checked up on your balance, go check and see because you may actually have those payments already waiting for you. If you did not receive your stimulus payment the first time around via direct deposit, but rather you got a check in the mail or a debit card, that may be the way you're going to get it this time. The IRS did give people an opportunity to register bank account details on its payment tool earlier in the year. So if you did that, you may be eligible to get that money via direct deposit, but otherwise, look out for it in the mail. If you are getting something by mail, it may not have arrived yet, and don't panic if that's the case. When it comes to issuing physical checks and debit cards, the IRS can only send out so many envelopes at once. And then we have to wait on our friends at the good old U.S. Postal Service to get the mail delivered, and especially if you're out in a very rural area, it may take some extra time for you to get that stimulus. So don't flip out if you don't have the money yet. Chances are you'll have it later this month. If you don't end up getting your stimulus payment by later this month, and you know that based on your income you qualify for one, what you'll then need to do is look at claiming that as a credit on your 2020 taxes, which are the taxes you're filing in 2021. So there'll be more information coming out on that, as the weeks go on. I think it'll be a little more clear as to how you claim that credit. I mean, I think I'm sure they're going to have to adjust, whatever the software is to alert people to claim it or enable them to claim it. Obviously, it's a new credit. It's a new concept, But the point is, Jeff, the money is coming. So for those who don't have it yet, sit tight. It'll probably arrive. And if it doesn't arrive, don't panic that you're not getting it. You may just need to claim it when you file your tax return between late January and mid-April.
Well, thanks for that, Maria. And I would say a lot of work to be done. We have a new Congress, right? And we have a new president starting January 20th. The new Congress already sworn in, new president starting January 20th. A lot of work to be done to mitigate and disrupt this COVID not vaccine. We don't want to disrupt that, but this COVID. We definitely do not want to disrupt that. A lot to happen there. I'm sorry. Go ahead, Mar.
No, exactly. No, I was just laughing. Yeah, no, we don't want to disrupt the vaccine. The vaccine rollout's been slow enough as it is. But, yeah, obviously, Joe Biden and his cabinet have a lot of work ahead of them because we've got a pandemic to get under control. We've got an economy to dig out of a hole. I want to be hopeful that, once we have a new administration in office, that things will start to move in a positive direction. I also want to be hopeful that there will be a third coronavirus relief bill. What that would look like, it's just absolutely too soon to say, so we're not even going to speculate about that. But I do think that that Biden is going to step in and try to help us all recover from this, horrible, horrible situation. So let's just hope that this, that the rocky start, I'll say, based on yesterday's news, that this rocky start to 2021 starts to get better after Inauguration Day.
Yeah.
That's my hope, Jeff.
I would say that's a complete understatement. But we'll leave it there. Mari, always a pleasure chatting with you. Happy New Year. Great information as always. And we'll check back with you in a couple weeks.
Sounds great, Jeff. Take care.
Thanks, Mark. Bye-bye. Welcome back. And now we're going to talk technology. Joining us on the line is Seven Investing's lead advisor and executive producer, Mr. Daniel Klein. Dan, Happy New Year. Thanks for joining us, and welcome back to the program.
Happy New Year. Wow, Jeff, this has been a very, very long week, so I'm glad we finally got to Thursday.
Absolutely. Let's talk, Dan. You've got two really great stories. I mean, there's so much going on in the technology world, but let's talk about why don't we do the Amazon story first, because now they're buying planes apparently.
Yeah, so Amazon has taken advantage of what's been going on, and they just bought 11 planes from mostly Delta. And this is basically they've noticed that the airlines are retiring some planes. They're looking to get out from under some planes, and they're able to buy them at very favorable prices. Previously, Amazon had leased planes, but the real story here isn't that Amazon is buying planes. They've been in the plane delivery business for a while. It's the bigger issue that Amazon is very clearly looking to have its supply chain, if not totally, largely under its own control. So, FedEx saw the writing on the wall, a few months ago, and they backed away from doing business with Amazon. They basically said, we'll do business with everyone else. We'll be the provider for Walmart. We'll be the provider for everyone else. We won't touch Amazon. But UPS and the US Postal Service have very, very strong relationships with Amazon, and those relationships are being hit on two ends. First, Amazon is doing last mile delivery with its ubiquitous vans, which are all third-party businesses, but Amazon helps with the funding there. And they're moving into air travel to plane freight, and this eventually is going to mean Amazon shutting out some of these other companies. It's a big change, and it's good news if you're an Amazon shareholder, or frankly, probably an Amazon customer. But it's a major, major shift.
So Dan, you have good relationships, and I've been those. I think you and I have talked about the Steve Jobs biography before, and I think back to when the Macintosh was created, and Microsoft was doing a lot of software for the Mac, and then at the same time they were developing Windows 3.1, which was not that great, but eventually got to Windows 95. I guess my point here is, Dan, is that you've got this partnership with UPS, with FedEx, with USPS. Is there the same kind of mentality where Amazon believes it can do anything better? Do they start? I'm not saying an airline. I'm not talking about an airline, but did they start their own delivery service through the air? They use these 11 planes, and does that put at risk the relationship with these other vendors?
So they're rapidly working to not need those other vendors. Now,
Mm.
might there still be relationships with USPS and UPS? Yeah, I imagine some percentage of Amazon business will go there, but they're not making it a secret that they want to control their supply chain. And this is really important. So if you order a pizza from Domino's, your experience is almost always better than if you order through a third party. You're not paying delivery fees, you're not paying higher prices, you're not subject to, well, this didn't show up, and you call the delivery company and they say it's the restaurant's fault, or the restaurant refunds you money instead of making sure your order is right. Controlling your customer relationship is really, really important, and that's what Amazon is doing here. They're looking at building the capacity, and this is going to enable other businesses for them. Amazon has gone into the prescription drug business. You
Yep.
can have your prescription filled by Amazon, but it takes 2 days for the first one to come in. And generally, when you get medicine, if it's not a recurring medicine, you're not like, oh, I have strep throat, I'll wait 48 hours to take the medicine. You want the medicine now. But if they get to this type of, they control the entire chain, and they add a few thousand grocery stores, and they build out some bookstores, and they build out some four-star stores, they may have all the points needed to do same day or even 2 hour prescription delivery. So Amazon is just building and building its capacity. And if you're an Amazon partner, you should be very, very wary, but you always should have been wary. If you're UPS, I don't know, maybe try to sell yourself to Amazon. If you're the United States Postal Service, recognize that this business is going to be you delivering in rural areas that Amazon doesn't want to go to. It's not going to be this pervasive deal that it is now.
Yeah, it's going to be interesting to see how this kind of unfolds in 2021 and beyond. Dan, let's talk about streaming services. Another one of your quivers in your professional era. You know a lot about streaming, a lot about consumer electronics. Let's talk about Discovery Plus. Everyone's coming up with streaming service. Dan, I feel like we should have one. Well, we do,
Yeah,
kind of. We do, kind of.
we do, and we might in terms of bigger aspirations. So Discovery Plus is kind of, I keep saying this, it's kind of the last bastion of content that when bundled together might be worth buying. I see some problems with it. Now, this is a lot of networks I watch. It's HGTV, it's the Food Network, it's the Cooking Network, it's whatever channel 90 Day Fiance is on, which has like 18,000 spinoffs, and I can't believe I watched that show, but during the
90
pandemic,
Day
it's been,
Fiance. Okay.
I need brainless things to watch.
That is
during
in my opinion, it's brainless, but we're probably offending some of our listeners right now.
So yeah,
I
probably.
am. I am.
So it's one of those things where I look at the package and I say, okay, this might be worth it if you've cut the cord. But I see some negatives. First of all the content they're offering is on demand, meaning you have to decide, I want to watch an episode of Diners, Drive-Ins, and Dives. And most of this content isn't content that most people consume that way. It's you turn on the Cooking Network, and whether it's Chopped or Diners, Drive-Ins, and Dives, or I don't know, Celebrities Can't Bake, or whatever those shows are called, you just kind of watch it. It's background noise. It's filler. I'm not sure that there are that many people that watch those shows on an on-demand basis, and I think they're making a big mistake by not giving you the linear streaming versions of those channels. Now, there may be rights reasons why they can't. So it's a really good package of content. It's a lot of content that I watch, but because I do have access to that content in two ways, I'm a Sling TV subscriber, which gives you most of those channels, and I have cable through my HOA, which is Comcast cable. It's pretty lousy. I don't see any need to have this. If I didn't have those two services, maybe I would get it. And I do think it's possible that this will be a limited success. It doesn't need to do Disney numbers to be successful. It wouldn't shock me if they got 12, 15 million subscribers, sort of and growing slowly as cable continues its slow / increasingly fast demise.
Dan, as a frugal person like myself, I try to minimize my subscriptions, right? I subscribe to the internet. I use Google Fiber. I think we've talked about this on the program and personally together. We use a Roku box, and then I might have Netflix and Amazon Prime. But where do you draw the line? And are there too many flavors? Are there more than 31 flavors to use the Baskin Robbins analogy?
So yeah, there are absolutely too many flavors. That being said, I don't draw the line because in
Well,
somewhat
it's your job, though, Dan.
yeah,
It's your
I do
job.
consider it part of my job, but also T-Mobile pays for my Netflix. I get Peacock for free because I have Comcast as my HOA provided cable. I would not have cable if the HOA didn't include it. I have Prime because I watch a couple of shows on Prime, but mostly because I have Prime for Amazon package delivery. I got Hulu because my wife wanted to watch Killing Eve. I have Disney Plus because I wanted to watch The Mandalorian, and now I want to watch about 15 other shows that are coming up. Excited for WandaVision in a couple weeks. So it's one of those where I keep adding to them, but I do think that most people should be judicious and take advantage of the fact that in general you can come in and out of these services with no consequences.
That's
So
good.
I'm a big fan of, hey, jump onto Netflix for 30 days, watch what you want to watch, and then leave it for a few months. I don't personally do that because there's 3 people in our household and the other 2 all use these services more than I do. But I do think you can be really careful. One of the things you want to watch is if you've cut the cord, you were paying 120, 180, whatever the money is for cable, and now your internet bill goes up by $5 or $10 because you're not bundling cable, and then you start layering on these networks and you layer on Hulu Live or Sling or who knows what else. All of a sudden you're spending the same amount of money for a much less convenient package, and that can be really, really tricky.
Yeah, I was going to ask you, and maybe you just kind of outlined it. I mean, if you're thinking about cutting the cord, and there are millions and millions of Americans who are doing this, and people around the world, not just Americans around the world. What are how do you make that decision, Dan? Just in a minute's time. I mean, I know it's longer than that, but how do you begin the process? Because people out there may be thinking about dumping their cable provider or their satellite provider and doing that.
So I actually have a process for this. So you have to sit down with everyone in the family who watches television. And I live in a 3-person household. My son watches very little linear television, so he doesn't matter. But I would have my wife and I make a TV diary. What did we watch, and was it important to us? So I watch, certain sports, we watch Law and Order SVU together. We watch The Simpsons together. So then I would look at, if I cut the cord, how do I still get all the important things I want to watch? And you might look at it and go, well, I can get 80% of it, but I'm going to have to go, and I know this isn't possible at the moment, but let's pretend we're not in a pandemic. I'm going to have to go to the bar to watch Celtics games. Or I'm going to have to catch up on this show that I like a year later when it comes out on Netflix. Like maybe The Flash, which is on CW. Maybe I can't get the CW. So you're going to have to look at what the sacrifices you're making and is it worth it? For us, it's always been worth it to have a cable-like service because my wife and I watch really different things. So it's not all that easy to bundle together. It's a lot easier to cut the cord if you're just one person or if you're a couple that has really similar tastes. But if you look and you say, okay, I'm getting really good value out of cable. We each have 10 shows we watch, and if we cut this, we're going to lose half of what we watch, and it's not easy to replace. Well, then maybe for you, cable is a really good value. There are some pretty major advantages to having, hundreds of channels. Now, that being said, I have Comcast included in my HOA, and it's such a lousy interface. I'd take $50 back to not have Comcast, and I would cut the cord, and I would use Sling and various other things. But in general, our previous cable, which was DirecTV, which goes out when it's windy or rains at all, but other than that was a decent service. I think you really have to look at, am I getting my bang for the buck? Like Netflix, it isn't worth it for me, but my wife probably watches 5 or 6 hours of programming a week. So what does that work out to? A couple of cents per show?
Yeah. Well, I think it all comes down to communication, as you're saying, and you got to have conversation and figure out what everyone watches. Maybe do a matrix. Dan, always pleasure talking with you. Have a great rest of the week, and of course, we'll see you for double duty on the network on Tuesday.
We'll see you Tuesday.
Thanks, Dan. Welcome back. Now we're going to talk markets, and joining us, markets and cryptocurrency. Because he's dual faceted. Joining us online, he's the Lamar Jackson. Or Josh Allen, no, because you're a Buffalo guy, right? You're the Josh Allen. You're dual threat quarterback here for Delphi Digital, the co-founder of Delphi Digital, Mr. Kevin Kelly. Kevin, that was a heck of an introduction by me. Thanks so much for joining us on the program this morning.
Thanks so much for having me, Jeff. Appreciate it.
So let's talk about markets because they've been, I don't know, stellar, amazing. At least the Dow Jones has been amazing. And I want to kind of separate issues because I want to separate the economic issues from the market issues. So let's talk about the market, get your thoughts about that, and then we'll talk about the economy.
Yeah, so no, I mean, markets have been, I think stellar is a great way to put it. If you look at, yes, the Dow is up. I tend to look at the S&P 500 as the U.S. equity benchmark gauge. Yep. If you look at year to date, what's interesting so far in 2021 versus 2020, and you started to see a bit of this rotation at the end of last year, but really what's kind of led the S&P this year, you look at the best performing sectors, the top one right now is energy, and tech actually kind of falls to the middle of the pack and is relatively flat on the year, right? And so when we talk about a lot of the themes we've been going over in the show for a long time now about kind of growth versus value and what really drives the equity markets, tech is obviously a very large portion of that, and so it's tough to make the argument that the S&P or that U.S. equities can continue to march higher unless these other sectors really start to take over some leadership, right, and rotate into kind of leadership positions. And so far you've seen that a bit to start this year. A lot of that is really, I think, being driven by this not only reflationary narrative and a pickup in economic growth potentially on the back end of 2021, but also that drives, again, your energies, your materials, some of your more kind of cyclical sectors. Tech, on the other hand, it's kind of an interesting double-edged sword where tech actually really thrives in an environment where you have, low economic growth or below average economic growth, and you don't really have that kind of robust cyclical recovery that a lot of people are talking about, because again, you look for growth, which are usually considered, growth names. You look for growth type stocks in an environment in which you're not getting growth elsewhere, right? True economic growth. And so I think what's going to be a big theme that we're going to be watching this year in 2021 is, if we do see the equity markets continue to trend higher, what is that going to be led by? And I think it's definitely going to have to be led by a bit more cyclical participation, because again, there are some headwinds that could be facing tech over the longer term. Now, really quickly, I'll caveat that with, in the short run, and this kind of gets into the economic issues that I'm sure we'll touch on. You had a relatively disappointing jobs report that came out just this week. You had jobs falling in December. You've got a headline on Bloomberg right now that literally says U.S. jobs fell in December as virus surge hindered activity, right? So it's this classic. We still have a lot of uncertainty around whether or not we're going to be extending certain lockdowns, especially as you look outside the U.S. and these kind of new strains of COVID. And so again, there's still a lot of uncertainty that, part of which is baked into the market, I think, and part of which is why we're actually still seeing equities at all-time highs. If it kind of is a bit counterintuitive, but people are looking for ways in which to kind of fight that inflationary hedge, and equities are certainly a great way for people to be able to do that. Especially tech.
Thanks for that, Kevin. Now let's switch gears, and you hinted at this with the jobs report. let's talk about economics, because there is a disconnect. They don't move parallel. We've talked about this for the last year, and prior to that on the podcast, that markets and the economy can be divergent in terms of where the health of the economy comes into play. So give us your assessment, or please provide your assessment. I don't want to demand anything from you, but please provide your assessment when it comes to the current economic conditions and some of the key indicators, leading indicators.
Yeah, so one of the big ones that I tend to watch is the yield on the 10-year Treasury, right? I think that's one of the purest kind of plays, or I should say, used to be one of the purest plays, looking at what market expectations were for base real economic growth as well as inflationary expectations. And so when you've had this low yield and low trending rate environment, part of that was because, yes, you had, Fed and central banks cutting interest rates, but also in the what we call the long end, or looking farther out, the 10-year or the 30-year, part of the suppression there on yields was driven also by a below average or worse than expected kind of economic outlook, right? So the economic growth factor has been relatively large on the long end. What you've seen recently actually is bonds have sold off quite a bit, and when bonds sell off, yields tend to rise. And so what you're seeing now is a rise in nominal Treasury yields, which I think has surprised a lot of people, especially coming into the beginning of this year. The question now is, does the Fed come in and basically at a certain point, let's say the 10-year gets to 150, it's at right around 104, 108 basis points today. If that goes up to 150 or even potentially 2%, does that force the Fed to come in and do something pretty drastic like yield curve control, right? Because they don't have a ton of bullets left, at least in my opinion. I think what we've seen so far is that monetary policy is really starting to kind of run its course. And so the big theme for 2021 is, where do rates go? Do we see some type of yield curve control from the monetary front? But then the bigger kind of argument is how big of a role is fiscal stimulus going to play? Because that's what I think is unique about this time around, is you really need fiscal to kind of take the driver's seat here to combat some of these economic indicators that rebounded and now are starting to roll over again, because you're getting into the winter months, because you're getting into this recent spike in COVID cases and things like that.
So, Kevin, I mean, if people are out there, we've got $600 stimulus checks that came, I guess, the first week of January, maybe the Monday before the first of January.
Mm-hmm.
A lot of people without jobs. I mean, are we bullish enough to think that things can turn around? We can get through this, and this is more of a theoretical question. We can get past COVID-19. People are getting vaccinated, and there may be an increase in hiring. The business conditions will reflect that, and we can get more people, the 10 million people or whoever, out of work and relying on this stimulus or this support, that they'll get back to, that they're going to have some job available to them.
I'd like to take the optimistic case here. I really would. But I think at least in the foreseeable future, I just don't think $600 really gets you very far. Especially for those, because you kind of have a bifurcation between people, right? You have some people on one end who are getting the $600 and simply just don't need it, right? So that money will potentially pile into markets. We actually saw a good amount of that money the first time around pile into crypto markets, right? Things of that nature, people getting exposure to assets. On the other side, on the other extreme, I guess you could say, the people who really desperately need it, yes, $600 is better than nothing, but it only goes so far, right? And so that's where I think we're going to really start at this inflection point of that K-shaped recovery we've talked about, where you have the haves versus the have-nots, and that inequality spread continuing to rise. I don't see that narrowing anytime soon, because the policies we have in place right now simply just are not conducive for people to be able to basically pull themselves out of this wealth inequality gap. I will say the longer term optimistic case is, I do think that obviously, you've heard about COVID being the accelerant for digitization and more activity happening online. If you look at like internet penetration rates and the amount of actually transaction volume that goes through the internet relative to global GDP, I think that's going to only kind of accelerate from here. And there is where I think you're getting a lot of opportunities opened up to people who otherwise, this could wind up being a blessing in disguise, and they end up taking a new position or a new role or joining a new company that's more digitally native, that is focused on something that they're actually truly passionate about. There is that optimistic case, absolutely. But I think in the short foreseeable future, I just don't think long story short, the $600 in stimulus is really going to be this kind of set it and forget it. We give it out, and then the economy comes right back to pre-COVID levels. I just don't see that happening.
Yeah, I mean, it's so basic, it's so minute. Even for if you have this minor spending habits, I mean, what we really need to do is get people back to work. We need businesses to hire people, and I guess that's the question for 2021. All right, Kevin, you were on earlier in the week on Monday talking about the Bitcoin. I call it the Bitcoin boom because we also did a show with your former colleague Devin Banerjee on Friday about the Bitcoin birthday boom. What has transpired during the week with crypto? I think that it hit super all-time highs again after we spoke. But what's the trajectory this week in terms of cryptocurrency and some of those key takeaways?
Yeah, I'm actually pulling up a chart right now because
it changes month to month or day to day.
We spoke earlier in the week, and it's funny. I think the day in which we spoke, I think Bitcoin was right around 33,000, and as of right now, it's trading around 41,000. Right.
Wow.
So an incredible rise. The thing right now is I'm starting to get a little bit cautious at these levels because again, we have seen a pretty incredible parabolic rise. Part of this is more institutional and sophisticated investors coming into this market, which you would assume would be what we'll call the longer term holders, right? Your people like Paul Tudor Jones isn't coming to this market for the quick trade to be in and out after even going up 2x. He's in this for the long run. I think we get a bit of a pullback from here, but that will serve as some type of buying opportunity because again, the long-term bullish trend, I think, to be quite honest, the cat is just simply out of the bag at this point. And I think you're just going to see more institutions and more investors, and that can be all the way from your retail investors to your large RIAs putting their client money into this as new investment products start to come to market. I just think the cat's out of the bag when it comes to Bitcoin, and then eventually some of this interest will trickle down into Ethereum and the broader kind of crypto asset space. But right now, I mean, Bitcoin's a great place to be, I think.
Kevin, is there any danger of a speculative bubble? Like, I'm old enough to remember the 2019, late 1990s, where you remember the run up. You were probably just a young buck, but there were, you probably, I'm sure you read about this and experienced it too.
Yeah.
The run up in the tech sector. We had a tech bubble burst. Is there any concern that we had this influx of institutional investors? You mentioned Paul Tudor Jones. There are Howard Marks and others that are coming, big names. But then down the line, there are other people getting it for speculative reasons. It inflates it, and then they're just trying to sell it off to that person who's uninformed and just getting in at the last. And they're like the third tranche of investors that can really get damaged and hurt.
So the short answer is yes. The risk is definitely there, and it rises. And no, it's a great question because the risk is there, and it rises as it's almost reflexive, right? As prices rise and as you get, better returns, that risk of, let's call it, I won't say manipulation, but really just pure speculative activity increases. Two kind of quick caveats. One, crypto is not nearly as big as what happened in the tech .com bust, right, in late 1990s, early 2000s. Mm-hmm. And the second, I think, is you don't necessarily the opportunities for investors to get into at least other broader crypto assets right now is much more difficult, even just from a mandate standpoint, because of the way in which these assets are designed, right? And some, you saw what happened with XRP and Ripple. Some are now being deemed unregistered securities. Some are trying to focus on decentralization so that they cannot fall under the kind of SEC purview or overview. So the way in which these assets are constructed is a lot different, and so it's not like the late 90s where you're basically buying the equities or the stocks of some of these up and coming tech companies that essentially slapped either .com on their name or put up a website, and for better or worse we're not investable. These are I think, to summarize, more esoteric, and in that case make it a bit more difficult sometimes for this kind of more institutional investor or high profile investor speculative bubble to really run up. Now, longer term, I do think though that the permissionless kind of nature of this space and the ability for anyone to really come in and start doing their own due diligence and get exposure to these assets, especially in a time when there's not a whole lot of regulatory oversight, that can be a cocktail for massive speculative opportunities. But I just don't think we're quite there yet.
That's going to be interesting. I mean, this is when Bitcoin's what, 12 years old. I mean, this has really been this is not a fast trajectory though, Kevin. This has really been a nice gradual growth, and yes, there have been has been volatility, but I would suspect that 2021 is going to be a very interesting year from the institutional perspective. If you get institutional buy-in, there's even more legitimacy, which it takes for a market. And things can really explode from there. I mean, you can not only with Bitcoin, but with all the other cryptocurrencies.
Yeah, no, 100%. Last thing I'll say is anybody who's interested, I would go look at a log chart, right? So not a linear chart because that'll show you huge spikes, but a log chart of Bitcoin since inception, right around when it started trading late 2010, early 2011. And you'll see it's to your point, it's almost a beautiful gradual, rise. You have these periods of kind of parabolic price moves. You have pullbacks as people take profits, kind of moves over from speculative activity to the people who are long-term holders, and then the cycle repeats, right? It's kind of a rinse and repeat. And so go look at a log chart of Bitcoin, and all these ideas of being a bubble and purely speculative, I think will be calmed a little bit.
Yeah, really interesting. I mean, it's just interesting to watch a market grow over the last 12 years. Well, Kevin, we've exhausted your brain, I'm sure. I think you have a lot better things to do. Really appreciate you doing double duty this week. Have a great rest of the weekend. Enjoy yourself, and we look forward to having you back on the program very soon.
Thanks so much, Jeff. Have a great one.
Bye-bye. Welcome back. And now it's time to take a look at some of the biggest social media trends this week. And joining us on the line is Devin Banerjee. He is Senior Financial Services Editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which, of course, you can find on the LinkedIn platform. Devin, Happy New Year to you. Great to have you back on the podcast this week.
Thanks a lot, Jeff. It's great to be back with you.
Well, I hope you enjoyed. I hope you had a really restful, as best you could, December. But I know that regardless of whether you're taking time off, you still kind of keep your focus in mind on what's happening on the world of LinkedIn. So tell us what happened this week with regards to finance and financial services.
Yeah, that's right, Jeff. It was certainly a wild week in the news, but I thought we would talk about the first jobs report of the year. Of course, it's the first Friday or the first working Friday of the year, so that means the Bureau of Labor Statistics has released its employment situation summary, or what we call the jobs report for the month of December. It's also notably, of course, the last kind of jobs report of this administration, of the Trump presidency, the month of December 2020. So, unfortunately, it was not a good report, some of which was expected, but here are the top line takeaways. 7 months of jobs growth has come to an end. First of all, it's important to note the economy lost about 140,000 payrolls, 140,000 jobs in the month of December. As I said, this caps off 2020 to, I think, let me just check. I think it is the worst year of job loss on records going back to 1939. So looking back over the course of the year, it's about 9.4 million jobs shed, and that eclipses the roughly 5 million jobs that we lost in 2009 during the Great Recession. So another indicator that the economy is in retreat, that it's in for a tough winter. But as I said, economists have been kind of expecting this. The writing has been on the wall for a couple of months. We saw falling consumer confidence, weak consumer spending starting to occur back in October, November. Of course, that makes it untenable for businesses to maintain payrolls and workforces going into the month of December. So economists did see that coming. Digging into the report a little bit, leisure and hospitality is really where we saw those job losses. Very, very heavy losses there. I think about almost 500,000 jobs lost just in that sector in the month of December. So really pointing to the bifurcated, nature of what's going on. That was where the job losses were really concentrated, while we saw some other industries add some jobs last month: retailers, factories, construction firms. So really getting to that bifurcated nature. So, looking forward, let's see, there are a couple factors that economists are really looking at. Number one, of course, we have to acknowledge is coronavirus infections. It's the health crisis, right? That has caused states and cities to impose new restrictions, new lockdowns, earlier curfews, business closures, causing consumers to, of course, just stay indoors. So that is, as I've been saying all along, and you and I have been discussing, that is the root of everything that we are experiencing over the past 9 to 10 months. Of course, we're in winter now, so that doesn't sound very meaningful, but really the onset of cold weather limits the ability of businesses, of course, particularly restaurants, to continue to host patrons or even host them outdoors where that's allowed. And then third, looking forward, we're going to be looking for that stimulus and that aid from Congress. So, that aid going to states in order to aid businesses and people, that of course just can bolster the balance sheets for businesses. It can bolster personal and household finances, which can spur consumer spending, which can then help businesses, which can then help them hire. So those are really some of the factors that are top of mind right now.
Devin, trying to be optimistic, if we can get people around the world, not just here in the U.S., but vaccinated, does that give us I would think that gives us a chance to maybe improve upon reopening, and also in certain parts of the country, because it is determined based on where you live, right, where the spread of the infection is. But I would think, and I'm asking you just to prognosticate a little bit, I don't want to put you too much on the spot, but do you think that this might create more opportunities for businesses to hire, like some of those smaller companies, smaller businesses that have been shuttered?
Yeah, absolutely. As I said, that is the number one factor, which is solving this underlying health crisis. And of course, the vaccinations are the way to do that right now. And as a matter of fact, just as we're recording this midday Friday, we're seeing some plans come out from the incoming administration, that of Joe Biden, to release most available COVID-19 vaccine doses all at once in order to speed delivery. That's a reversal of the approach taken by this administration, which was, I think, to hold back some of those second doses of the vaccine. And so, we are starting to see that panel and that COVID committee working with the incoming administration start to already plan for some changes that will occur just in a couple of weeks when that administration takes office. So, yeah, at the end of the day, Jeff, as I said, it's this underlying health crisis that we really need to solve for. At the same time, on the LinkedIn platform, one of our other popular items also related to jobs, and I should mention, why we talk about jobs and employment so much, of course, on this program, excuse me, which I know is focused on, saving and investing for retirement. But as I've said before, you can't invest if you're not saving, and
Absolutely.
You can't save if you're not earning, and you can't earn unless you have a job. And so jobs really are the start of it all. So another popular item, Jeff, was the jobs of the future. A lot of people don't realize, actually, that the Labor Department here in the U.S. puts out projections for employment a decade into the future. Their economists review scholarly articles, interviews, historical data, other sources, to estimate demand for specific occupations. And so we featured an item on some of those jobs that are expected to be in high demand in 2029. And really what it comes down to, Jeff, is the aging of the population. It's caring for people. It's caring for people and their pets as they age. That's really going to fuel explosive growth in certain jobs. So looking at what the Labor Department has put out, the jobs most expected to grow in demand or increase in employment between now and 2029, at the top of the list are home health aides. Also high up on the list, registered nurses, medical assistants, medical and health service managers. So you can see this theme that healthcare, Jeff, as you and I talk about quite frequently, is really a source of jobs for the future.
Yeah.
Also near the top of that list, fast food workers, restaurant cooks, and then I should just mention software developers, of course, as the economy goes digital and everything is digitized. Software developers, of course, will also be in high demand a decade from now.
Really interesting, Devin. And you bring up the aging population, and I read somewhere, and we're actually going to have a show on this later this month on the network. I think there's like $30 billion that's expected to transfer between generations. If I read that, if I'm recalling the study correctly, because I don't have it in front of me, but that is significant. So yes, there's an aging population. There's a big significant wealth transfer that's going to happen, and healthcare, I don't, any way you cut it, it's important to take care of yourself, and it's important to take care of generations that preceded us. And it sounds right on to me.
Yeah, absolutely. And yeah, as we talked about, unfortunately, as millennials, as the boomer generation ages, they are also passing away. And so, yeah, you are alluding to something you and I talked about a month ago, which was some research out of Cerulli Associates showing that the pace of inheritance for the younger generation from their boomer parents is set to, I think, double over the next 10 to 15 years. And so that is really changing the face of investing and the investment management industry, because the customers and clients of the future for that industry are the millennial generation, which is inheriting trillions and trillions of dollars of wealth, and they don't invest like their parents do. They care about ESG, environmental factors, social factors, governance factors. They care about the values of companies, and some other research I think we featured in that item from, I think it was Bank of America Merrill Lynch. Mm-hmm. Shows that the younger generation is much more likely to allocate their dollars to those companies that they care about. They're not just looking at the bottom line; they're looking at companies and their role in society.
Yeah, it's going to be interesting to see, Devin. I mean, we got a lot of years for that to happen, but I think you and I are going to be having some very interesting conversations. Well, Devin, I want to wish you it's great to have you back, first of all. We love having you on the program. Love having you do double duty on a Friday, record the podcast, and appear on the network. Take care of yourself, and we'll look forward to having you back next week.
Absolutely, Devin. Take care.
Bye-bye. Welcome back, and now we're going to chat a little about real estate and also travel, and who better to do that than Mr. Jacob Passy. He is real estate reporter and travel reporter for Market Watch. Jacob, Happy New Year to you, and thanks for joining us on the program this morning.
Yeah, Happy New Year to you as well.
Thank you so much. Hope you had a great time with your family. So let's, which do you want to tackle first? Let's talk about real estate, because that's always a hot topic, and that's one of our better listened to segments. What can you tell us? What's your perspective this week on real estate?
Yeah, so a report came out this week from Fannie Mae. They do a monthly survey of folks across the country, consumers, to gauge basically, people's confidence in the housing market, whether they think it's a good time to buy, whether they think it's a good time to sell. And what their survey found is that there is decreasing confidence among Americans regarding the strength of the housing market. So, they ask a variety of questions. So the question of whether now is a good time to buy, still over half of people in this survey said yes, but the number dropped. It's only 52% of folks right now. And then the number of people who said now is now a good time to sell also dropped. And that's a little concerning. What the researchers at Fannie Mae said is this is clearly a reflection of, the rise in COVID cases. This survey happened back in December when things were really starting to hit a fever pitch. And we're just seeing record-breaking day after record-breaking day, and that is weighing on people right now. And I think it's, causing people to feel like putting a hold on, big life plans. And then on top of that, this week on Friday, we got the new jobs numbers, which showed, a decrease, a drop, a pretty significant one, again, tied to the rise in COVID cases, because a lot of parts of the country reintroduced pretty strict restrictions on activities, ended indoor dining in some areas, things like that, which obviously hurt employment. But as that type of stuff continues, there's a very good chance we'll see, confidence continue to drop. And especially if sellers are not confident, that's a big deal for the market. Because like you and I have talked about for a while now, there's this whole issue in the market right now where there just are not enough homes up for sale for the, amount of demand there is. And so if sellers become even less confident and choose to, hold back from selling, then that'll restrict, inventory even more and cause prices to rise, et cetera.
Yeah, look, I think there's a lot to be said for what you just mentioned, Jacob. How now typically, like forgetting that this is a COVID pandemic, how is the market typically, just to give it as a benchmark, what is the market typically like in that report at the end of the year? Is it usually up? Is it kind of steady? Just in previous years, just so people have a comparison.
Yeah. So good to provide, the year-over-year comparison. So, compared to a year ago, the index, it's on a 100-point scale, was down about 14 points in December. So that kind of gives you, a picture as to how much of this is, a reflection of the pandemic. While I think this survey, like a lot of, the other real estate data we get, is seasonally adjusted. So they're taking into account, factors related to seasonality, because the winter is usually a slower time for real estate, for sure. This is the time of year when people are kind of hunkering down. The reason we see more activity in the spring, for instance, is because people want to buy, want to get a contract done before the summer so that they can move over the summer, and especially if they have kids, so that they can get them, settled with school before the school year starts. No one really likes to move their children in the middle of the school year. Absolutely. So winter is a slow time for that reason. But, year over year, the survey was down quite considerably. Which is, on the one hand, you might think, well, that's surprising because, interest rates are so low right now. They're significantly lower than they were a year ago. But it just shows, how even with that as, a major, carrot to lure people out into the market, it still is causing a lot of people to start to have concerns because of the pandemic.
Yeah, absolutely. And also maybe some economic uncertainty as well. Jacob, let's switch gears and turn your hat to the other side, and let's talk about travel, because so many Americans, if they have been traveling, maybe not a great idea, but maybe they've been doing it by car. What does the travel environment look like now in 2021? Many people probably haven't had a real vacation in a long time, over a year.
Exactly. And that's, pretty much the exact question. I'm working on a story right now looking into this question of airfares. What's going to happen to the price of airline tickets? We've got the vaccine rolling out slowly, I guess, but it's rolling out. And I think there are a lot of people who are, I'm in this boat too. It's been a rough year, and we're eager for a summer vacation that we could actually enjoy. And so I think there's a lot of people who also want something to look forward to during these bleak winter months amid a pandemic. So there are certainly a lot of people who are starting to think about their spring and summer vacation plans, hoping that maybe by then they will have the vaccine, they will have been vaccinated, and it will be safer for them to travel, albeit probably with certain restrictions still in place. So I asked the question, and I reached out to a lot of travel experts, what does that mean for airline prices? Are they going up? Are they, has the vaccine caused a surge in airfare prices? Are prices getting more expensive for the summer? And the good news is, for now, things are still cheap. Depending on who you talk to, different people in the industry kind of give different responses to that question. Interestingly, it does definitely seem to be the case that airfare is much less expensive for domestic flights. International flights, it gets a little trickier because certain countries have restrictions, barring Americans from traveling because of the pandemic. And so in those countries, you might need, there probably are very few flights to and from those countries. And, with that, reduced number of flights each day, that'll make things way more expensive. But, for domestic flights, airfare prices do seem to be down. Now, they're not down, necessarily as much as you might expect. And that's in part because throughout this whole pandemic, airlines have been taking measures to reduce their costs. Because, it's expensive to keep a lot of people employed, to have all these routes, et cetera. So they're running fewer flights a day between their routes. They've, in some cases, cut the number of routes they're serving, things like that. And so while prices are down because demand is still, way down from, 2019 and years before, at the same time, they've reduced, they've basically reduced the number of flights there are. And so that helps to counteract some of the reduction in price that would come from all of the decrease in demand. And it's not clear, what's going to happen moving forward. Part of the problem here is that as travel demand comes back, airlines are not going to respond right away just by adding a ton of more flights. If for some reason folks buy a bunch of tickets and then there's, a third wave or a fourth wave, whatever you want to call it, of the pandemic, or something goes wrong, then they don't want to be sitting on all these empty flights. It's expensive to run an empty flight. So the response from airlines will probably be delayed, which means that if demand is high, you could see prices go up pretty quickly once, demand comes back, because a lot of people will be fighting for very few seats available on flights.
Jacob, let me ask you about cruises and also the hotel industry. Both hit very hard. Any sentiment? I know your story is about airfare, but have you heard anything about cruise lines? Are they doing any advertising? How about all those hotels that had to shutter, lay off workers, et cetera?
Yeah, so with the cruises, back in October, the CDC chose not to extend their no sail order, which meant that cruises could resume operations, but under very specific restrictions. So while the CDC did not extend their no sail order, they instead chose to basically issue a requirement that cruises have to get the sign off from the CDC to resume sailings out of the U.S. anyway. And so there are a number of things they need to do, requirements the CDC put in place. For instance, they're required to basically be able to test passengers on the ship pretty regularly. They're requiring, passengers, when they go back into effect, for passengers to get tested before boarding, while on the ship, and before they exit the ship. But that's at every step of the process. So let's say, it's unclear once cruises start, operating again, whether they'll be doing that many ports of call. But let's say, your cruise stops in Puerto Rico or the Dominican Republic and you decide to get off the ship, you'll probably have to get tested before getting off the ship there and when you get back on the ship after being in that location. So it's going to involve lots of testing. It's going to involve modified service. A lot of the cruise lines are changing the way their, restaurants and buffets operate. Certain activities won't be available, etc. They are certainly booking for cruises later this year. It's unclear yet when they will really start to be in operation. First of all, they need to get their, in a lot of cases, staff of cruise ships are from all around the world. They're not, all Americans. They are, they hail from all around the world. And so it'll cost a lot for the cruise lines to get all those people back in the U.S. They'll probably have to quarantine before they go on the ship themselves. And then they need to basically do practice sailings to prove to the CDC that they can handle all of these requirements. So it's a pretty intense process.
Yeah.
You are starting to see some of the cruise lines advertising for jobs. So that's a sign that, sailings may resume sooner rather than later. But I don't know that we've seen any of the cruise lines fully do all of this process to get the approval yet. And so it remains to be seen whether the CDC is going to be very stingy with issuing these approvals or not.
Yeah, look, I think... Oh, I'm sorry. Go ahead. Go ahead. Finish out your thought. I've got about a minute left. I'm sorry. Sorry.
No, it's fine. Hotels, I just wanted to quickly say, it's a difficult time for hotels. We are certainly seeing some of the smaller hotel operators struggle, and some, independent hotels have folded. One story that I'm working on is looking at, whether, there's this kind of growing idea of converting hotels into housing, because it's a pretty easy thing to do. They're pretty much already set up for it, and they're number of companies that even before the pandemic were doing this, with more dilapidated hotel properties and things like that, rehabbing them and turning them into apartment complexes. So it's an interesting idea. I think that the common thought is with hotels is you can, if there's less expense per se, if you own the building and stuff like that, less expense involved for a hotel potentially, as compared with a cruise ship or an airline where you're paying tons in fuel and stuff like that just to run in general. So a hotel can run at a reduced occupancy, perhaps a bit easier than an airline or a cruise line could. And I think the idea is that enough hotel operators are being able to kind of withstand the pandemic. And I think the hope is that come the summertime, folks will start staying in hotels in earnest again, and things will, get back to normal pretty quickly for that segment of the industry.
Yeah. Well, Jacob, thank you so much. I mean, this was a very deep dive in real estate, travel, cruise lines, hotels. I want to really appreciate it. I want to wish you a very happy weekend, and we'll talk to you again next week.
Yeah, talk soon. Take care. Bye-bye.
Welcome back. Now, time to talk about the year ahead in retirement legislation, regulation, and who better to do that to start the new year out than our two legal eagles, or is that legal beagles? I don't know. David Levine, Kevin Walsh, both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, happy New Year to both of you.
Happy New Year, Jeff, and we are the legal labradoodles.
Legal? I don't even know. Okay, that'll work. Kevin, do you agree with that?
I think legal labradoodles, that works for me this week. I think that works.
Okay. Well, okay. So let's talk about the year ahead. Lots of we have a new year, new president, change in parties in the U.S. Senate, changes in the U.S. Congress, new Congress sworn in. What are your thoughts about legislation, regulation for retirement and benefits going forward, guys?
So thanks, Jeff. I'm going to talk a little about from a year ahead, and I think David's going to talk a bit about the legislative outlook. And the key here is that when we think about the administrative outlook, on January 20th at noon, Vice President or President-elect Biden will become the next president. And that's going to have significant repercussions for the administrative agenda. Last week we talked about the things that the Trump team accomplished during their 4 years in office. And I think we'll begin to see some of those wound back, while I think we'll also begin to see some new initiatives. In the first half of this year, I think the bulk of what we'll see are going to be, administrative actions talking about giving the Biden team time to review some of the items that the Trump team got done last year. So we could see there was an exemption that was issued at December 18th. We could anticipate that the Biden team will seek to, delay the effective date of that exemption in order to give them time to determine if it's something that the Biden administration wants to have take effect, or if it's something they want to revisit. Similarly, we've had recent rules take effect related to, environmental social governance investing and proxy voting. Those will be in effect, but we wouldn't be surprised if the new Biden team has at least comment periods to solicit additional input on whether those are going to be consistent with, the new administration's incoming goals. And in particular, their goals with respect to social justice and environmentalism. And then the last piece that we really see from a retirement standpoint this year is I think there's some likelihood that either the Biden team or the Trump team in its final days get governance out on things like, auditing standards or things like missing participants. We're hearing that, guidance may be close on those, that the career staff is on board with the guidance on those things. And those are areas that traditionally haven't been all that political. So it wouldn't surprise us if anything that's been in the works for a number of years at DOL either comes out in the last few days of this administration, or once the new administration's had time to look at it in the first few months of the new administration.
Well,
David,
Kevin,
you want to talk a bit about? Yeah.
Yeah, I want to add one thing. The IRS. We talk a lot about the DOL. The IRS at this point remembering that the IRS doesn't have the same sort of political leadership in the land of benefits as you do in the Department of Labor. I think they're going to keep moving on. There's two things to mention. First, because I have to say it for a new year. It's my first chance to sort of jab you about missing participants. You already got it in the first word, but the IRS and Treasury put out some of their sort of compliance focus, and they are focused on people taking minimum distributions. And there's been talk of IRS Treasury putting out guidance on missing participants. So I think that's definitely continuing. Second, one of my favorites, 1/1/2021, PEPs became live, pooled employer plans. As of yesterday, there were about 30 something filings for people who are going to offer PEPs. But there's a lot of questions out there. And I can tell you, working on these every day, there's a lot coming up. We'll get guidance at some point here, but that's something else to expect. But let me flip to legislative.
David,
yeah.
Before you flip to legislation, your voice sounds a little bit hoarse. Are you doing okay?
Oh yeah, I'm great. I have been celebrating the first round of the legal labradoodles this year. So I was up late with the great celebration for our first recording. So that's all it is. But back to legislation. Legislation. Obviously, as we're recording this, it looks like we're going to have two Democratic senators coming out of Georgia. And given that, the control of the Senate come January 20th will flip from a Republican under Leader McConnell to Leader Schumer, with the Democrats having 50 senators and the new Vice President Kamala Harris being the tie-breaking vote. So they will have effectively 51 votes. There's been a lot of questions, and this ties to the regulatory side as well, as who's going to be appointed when and where. 51 votes makes it a lot easier for the Biden administration, as it relates to our world, to pick folks who might be more progressive, for instance, in their views in running the Department of Labor's Employee Benefits Security Administration. Plus,
so David, let me chime in on appointments, though. I think you make a great point that it allows the administration, if it wants to move more left in terms of appointments, but it does tie their hands on one thing, which is, there had been some discussion that you'd have someone like Senator Sanders head the Labor Department, or Senator Warren head Treasury. I know there's another name there, but with a 50-50 Senate, it becomes very, very unlikely that we will see a sitting senator appointed.
Yeah. You can't, if you pull a senator, it upsets the balance. And then there's the replacement rules. Yeah, I agree. The odds of seeing any senators walk out of the chamber into the Biden administration, I think, is very slim at this point. There are some jurisdictions where a Democratic governor might replace a Democrat, and that's what's going to happen with Kamala Harris, for instance, in California. But at the same time, you're 100% right. There's a lot of discussion there. But what does it mean for our legislation? Well, as all of us know, at the end of 19, after years of Kevin and I talking about it, we got the Secure Act that went through, and that was a bipartisan bill in the end. Secure 2.0, when we've talked about it before, and I'm sure we'll talk about what comes out soon in coming weeks, got a lot of support when it was announced late last year. Plus, we have the Retirement Security and Savings Act, which is a lot of what's in Secure 2.0, or Secure 2.0 has a lot of what's in there. They're not identical, and there's some disagreements, but there seems to be a lot of consensus. Now, as we said before, Secure took a long time, so we'll have to see how this goes. But I think if they're looking for areas where people agree, even though it's unified Democratic control, but by the slimmest of margins, this could be it. I think the bigger question is, what about things like more progressive things like revisiting the fiduciary rule of the exemptions? I think there's a lot of texture to that we won't get into here. There is what the Trump administration put out in its recent exemption that's sort of as part of the reinstatement of the old fiduciary rule formally. That exemption, some people love it, some people don't. Some people think it's a middle ground. So maybe that takes a little bit of the air out of legislation. But even more importantly, everybody needs to remember, in the Senate, for reconciliation bills, like funding bills, you need 51 votes. For most other legislation, let me finish, Kevin. For most,
okay. I was going to chime in with a pithy comment.
Well, it's okay. My celebration clearly has caused me to lose my sense of humor too. But no, all jokes aside, people should keep in mind we need 60 votes in the Senate for a lot of legislation and a lot of things that aren't revenue related, such as things like the fiduciary rule, would make it hard to do a radical rewrite of it at this point. I don't mean radical in terms of political. I just mean it's not so easy to do. Kevin, go ahead with your pithy comment, and I'll leave it to you to close out.
I was going to say that in 2021, we're really living in Joe's world. And by Joe, I mean less Joe Biden and more Joe Manchin. As he's going to be the key vote on reconciliation matters, on confirmation matters, and on anything related to rules.
Agreed. As goes Joe, the nation goes, as goes Joe. Agreed.
Hey guys, just real quickly, in terms of kind of reversing or looking at Prius regulations and unwinding some of that stuff, what in terms of time frame, what does that typically take? Is that a 60-day? Just want to give the audience a little bit of a understanding. Is that like a 30-day review? Is that a 90-day review? A 120-day?
Jeff, you just uncorked the next favorite thing behind missing participants for Kevin. Kevin, can you give us a 35-minute lecture on that?
No, 35 minutes, maybe 35 seconds.
35 minutes. And I think basically what it comes down to is they're going to have to use the Administrative Procedures Act to make changes or delay these rules. And the quicker they go about making changes, the more vulnerable they'll be to legal challenges. So there's going to be a balancing act on the part of the new administration in determining, how quickly can they move while at the same time documenting that they're using a deliberate and thoughtful process.
Wow. Okay. Well, I guess more to come. Lots on the benefits front this year, guys. Thanks so much for your time today, and have a wonderful weekend. We'll look forward to having you back on next week.
Thanks so much, Jeff. Happy New Year.
You too. Bye, guys. That wraps up this episode of BRN Sunday. Hey, have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our newsletter, The Morning Pulse. Don't forget, we're back again tomorrow for BRN AM. I'll be joined by Bob Colley of Colley ESG. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.